This week we're going to talk about something a little bit different. We're going to start talking about the efficient markets hypothesis. If you've been taking economics courses for a while, you might get the sense that the way that economists use words is not always the same as how those words are used in plain English. So when we talk about an efficient market, we're not necessarily talking about something that operates smoothly, where trading is easy and it's relatively cheap. That's not really what efficient markets mean. It's not a market that runs efficiently. When we're talking about a market that runs efficiently, what we're really more talking about is a liquid market, and that's a topic we'll address in a future lecture. Instead, we want to think about efficiency in another sense, in that something that is efficient is not wasteful. We're making the best use of our available resources. So an efficient market is one that makes use of all the resources that are available. So what kind of resource are we talking about? Well, we want to think about information as a commodity, right? Because we think about what is a market? It's a collection of individuals who are making trades that express beliefs, that carry information, right? If I go and I buy shares of a stock, what am I really saying? I would say, I believe in this stock, right? I believe that there's something good about the stock that makes it worth buying. And in doing so, I'm communicating that belief to the entire market. And so when we're talking about an efficient market, we're talking about a market that aggregates all of this available information, that it's not ignoring any information that could potentially tell us something about how much these different assets are supposed to be worth. So we have the sense, right, that efficient markets are therefore markets where assets are priced correctly, where we're taking all the information that traders are expressing, all the beliefs, all of the attitudes that they have, and we're incorporating them into the price to arrive at what the price should be for everything on the market. Now, when we talk about what the price should be, well, that's a little bit of a difficult thing to pinpoint. If I'm talking about real assets, well, value for a physical commodity, that's something subjective, right? It's like the value of an apple depends on the consumer, right? Some people like apples, some people don't. So for a real asset, there is the possibility that people can disagree about the value of an asset and nobody is wrong, right? If I like apples and you don't, and I value apples more than you, there's nothing wrong with that. Neither of us is wrong. We just have different tastes. This is not exactly true for financial assets, right? That we talked about from the beginning. Financial assets have no intrinsic value. So just holding a stock holding a share of Apple as opposed to an actual apple doesn't have any intrinsic benefit. I'm not made happy by being an Apple shareholder. So how much I value this stock depends entirely about what kind of future payoffs I think I'm gonna get from holding it. And so if I value an Apple stock highly and you don't, so we have a disagreement, not about the intrinsic value, because there's no intrinsic value here. We have a disagreement about the future payoffs we're going to get from holding these shares. You think that the shares aren't going to pay as well in the future. I think they will. So with a financial asset, unlike with a real asset, if we have a disagreement, at least one of us is going to be wrong, right? It can't be the case that I just have a different opinion about Apple than you and we're both correct. That's not going to be the case with a financial asset, because ultimately one of us, or possibly both of us, will be wrong about what we thought the future price and the future payoffs to this asset will be. So We have, therefore, markets composed of traders, and all these traders are bringing different opinions, different beliefs to the table. Some of these will be more grounded in reality than others. And so we want to think about, well, is the market fulfilling its basic function? Is the market taking all of these opinions of different participants and aggregating them properly, incorporating all the information that every trade contains within it to arrive at a price that accurately reflects what the stock is actually worth? So the efficient markets hypothesis was postulated by Eugene Fama. So Fama also was partially responsible for the Fama French three-factor model that we talked about before. And the hypothesis says markets are efficient in the sense that asset prices fully reflect all available information. So this doesn't seem like it's saying that much, but in fact, the efficient markets hypothesis is saying quite a lot. So what is the efficient markets hypothesis saying? Well, if I think that I have some knowledge, some information, maybe I got a stock tip, maybe I know somebody who works for the company, maybe I just have, maybe I've done some analysis, I've been looking at the price chart, I've been looking at the company's financials, or maybe I just have some kind of gut feeling, some type of knowledge that I think is going to allow me to trade and make money. The efficient markets hypothesis says forget about that. Whatever knowledge, whatever information you thought you had, if it actually mattered, it would already be priced in. So whatever information you think you can trade on and make money, you can forget about that because that information has some way, somehow, already been incorporated into the market price of whatever it is you're trying to trade. And so more than that, what it's saying is that because all of the information that's relevant to the price is already priced in, it's impossible for anyone to predict where the price is going to go. There's nothing that you can do that will allow you to tell if the price is going to go up or if it's going to go down. Because if there was something that said, oh, well, this stock should go up in the future, then that information will already be priced in, which means the price will have already gone up. And what that means is that stock prices, asset prices, cannot be predicted and therefore are basically just random. So let's think about this let's think about this a little bit. The efficient markets hypothesis is making a very strong claim, right? It's saying that asset prices are basically just random. Therefore, making money trading stocks is just a function of luck. So why, on what basis can we make this kind of a claim? What is this based on? So a joke that people sometimes make is that, well, if you see a guy who believes in the efficient markets hypothesis and he sees a $100 bill lying on the ground, he's going to say, no, that $100 bill can't be real, because if it were real, somebody would have picked it up already, right? Basically, the efficient markets hypothesis is saying the same thing, right? If you think you can make money, forget about it. It's not actually there because that supposed profitable opportunity is just a mirage. Whatever information you thought you had is already priced in. Now, this example seems kind of silly, right? Obviously, if you saw a $100 bill on the ground, you just pick it up. But if you really think about it, how often do you really see money being dropped on the ground like that, right? So we can think about the efficient markets hypothesis saying it's not so much that it's impossible for there to be an opportunity to make money, but those opportunities are so rare that for most people, they're not even worth considering. Well, let's think about why that's the case. So let's imagine that I have some piece of information that's going to tell me that some stock I'm looking at is undervalued, that this is something that I should buy, right? Well, how can I express this belief? If I have a piece of information, how do I tell people that this is what I believe? Well, the way that I do this in the markets is that I do it through my trading activity. If I think that a stock is undervalued, I can express that belief by buying it, right? When I buy the stock, that's sending a signal to everybody else in the market that, hey, somebody believes that this stock is undervalued, that's why they're buying it. And as a result of me buying this stock, my trading activity is going to push the price up. If other people are seeing this signal and they also start to believe it, they're going to start buying the stock too. That's going to push the price even more. So as a result of my trading activity, I had a belief about a stock that led me to buy it. When I buy the stock, that causes the price to go up. It may cause other people to buy the stock as well. That's going to cause the price to go up even more. And through this process, the information that I had is now incorporated into the price. That information that my belief was based on is now incorporated into the market price. So when I'm talking about incorporating information in the stock price through trading activity, this means that any type of trend, any type of knowledge I could gather ends up, redo. Start of slide 6. So let's imagine that, well, where do I get my information from? Let's imagine I'm getting my information by looking at the stock price chart. I see the stock prices, maybe it's going like this. And I was like, hey, look, I've noticed something. I notice a positive trend, right? So, which means that right here, this price is undervalued. I think it's going to continue to follow this trend, and it's actually going to go all the way up here. So I'm going to buy. Well, when I start buying the stock, and other people who notice the trend also, or maybe read my signal, that's going to cause the price to go up. It's going to cause the price to jump. It's not going to continue to follow this steady trend, but it's going to start jumping. And in fact, once people notice this, they're really going to jump on the bandwagon. And so, what does this mean? If there is some type of trend, if the price of the stock had some information that allowed you to predict its future value, the fact that people can notice trends and then capitalize on them will inherently cause these trends to evaporate. Because what's going to happen here? If this is the true value, instead of continuing to follow the trend and slowly moving up toward the true value, once people notice the trend, they're all going to buy in. That's going to cause the price to jump immediately. And then after that point, the price is just going to be noise. It's not going to follow a trend after this anymore. Why? Because the fact that people noticed the trend caused the trend to stop. So there's a couple different forms of the efficient markets hypothesis. We have the weak form, we have the semi-strong form, and then we have the strong form. So, of course, each of these is saying more than the previous one. So the weak form says that prices reflect all information contained in past prices. So the weak form is saying basically that I cannot predict where the price is going just by looking at the old prices. The history of past prices does not allow me to predict the future price. The semi-strong form goes a little bit further than that. It says that prices reflect all public information. So not just whatever data you can get about prices, but anything about the company, anything in the news, any piece of information that any person could access, that's already priced in. The strong form is, of course, even stronger than that. The strong form says all information is priced in. Not just public information, but also private information. Even inside information is not going to allow you to predict prices, because some way, somehow, that information has already been priced in. So, the weak and semi-strong forms of the efficient markets hypothesis are a little bit easier to justify because they're dealing with public information. If I have a piece of public information that I think is relevant to the price, I'd better act on it right away. If I really think that this information hasn't been priced in yet and that nobody else has figured it out yet, I better act on it right away because I'm not the only one who can access that information, right? If I really think that, for example, just looking at an earnings announcement is going to allow me to predict where this stock price is going to go, I better do it right now because everybody else can see that too. So there's a competitive argument for these two, right? If it's a piece of public information and I'm not acting on it, somebody else will. For the strong form, well, it's a little bit tougher to say because this relies on the actions of insiders, right? If I'm an insider and I have a piece of information that is private and which potentially nobody else knows, then maybe I'm not in such a rush to trade on it, right? Well, for one thing, insider trading is illegal. People still do it though, but it's illegal. So I may not be able to just jump in completely, right? I may not be able to make the kinds of trades that I want to make because I don't want people to see my inside trading activity, right? This could be bad for me if I did that. But also, even if I wasn't afraid of that, if I have private information that's relevant to the stock price, I may not want to act on it right away. I may try to strategically withhold the information and wait until a point where I can make the biggest possible impact, right? Acting on my private information right away is not necessarily in my best interest. Sometimes it's better for me to wait and I can execute my trades at a time in the future when I can make even more money from it. So we can see from this picture that the types of information that each form of the EMH are dealing with are kind of nested within each other like a Russian doll, right? So if you think about just information in prices, well, that's a subset of public information. And that's going to be a subset of all information, right? So the weak form says the stock price includes all of this stuff. The semi-strong form says it includes the price data, but also all other public information. And the strong form goes further than that, says it's not just the public information that's priced in, it's all of it, all the public and private information. Okay, so one thing you might have noticed is that this is called the efficient markets hypothesis. That is, it's not the efficient markets theorem. What that means is that the efficient markets hypothesis is just a conjecture that has never been proven and, in fact, can't ever be proven. So, well, why are we spending so much time then focused on a statement that can't be proven? Well, the efficient markets hypothesis is saying a lot, and it really gives us a viewpoint a particular viewpoint about the way that asset prices are, right? So let's think about why the efficient markets hypothesis can't be proven. So let's try to imagine a scenario where the efficient markets hypothesis didn't apply. Okay, let's imagine that let's say I'm looking at a Tesla, okay? And I have some kind of estimate for how many Cybertrucks they're going to sell in the future. I realize that this is kind of dating this lecture, but whatever. I have an estimate of how well the company is going to do in the future, and that's telling me that the stock is undervalued. So I'm postulating that I have a piece of information that is not priced in. Okay, so the market price is here, but I think the true value is up here. Okay, so does this disprove the efficient markets hypothesis? Well, not quite, right? Because I have a statement that the current market price is not equal to the price that my alternative pricing model would indicate that the stock should have. But you can see the problem right away. There are two possibilities, right? Either the efficient markets hypothesis is wrong and the market is mispricing the asset, or my alternative pricing model is wrong and I'm the one that's mispricing the asset. The fact that the market price doesn't line up with the price that my model gives could disprove the EMH, or it could disprove my own asset pricing model. And so this is called the joint hypothesis problem, in that any kind of refutation of the efficient markets hypothesis will require some type of alternative. I need to show that by another model that there is a price for a specific asset that's different from the current market price, which would then indicate that there are pieces of information that are not priced in. However, just showing that the market price doesn't match up with what the true price I say should be doesn't disprove the EMH. It could just as well be disproving my alternative asset pricing model. So I cannot disprove the efficient markets hypothesis this way. Of course, proving the efficient markets hypothesis is even harder, because how could I possibly come up with a proof that shows that the market price is always containing all of the available information at all times? So the efficient markets hypothesis kind of lives in this gray area, right? It can't be just definitively proven. It can't be definitively disproven. However, it's making such a strong claim, and this claim gives us it really colors our perspective about how markets work and what their function is, that we have to continue to study it, but we have to keep in mind that we can never definitively show that it's correct or that it's incorrect. Okay, so I talked about how the EMH is important even though we can't really prove it and we can't really disprove it. And I said that the EMH really colors your worldview a lot. So what does that mean? Think about what the efficient markets hypothesis is saying. It's saying, if the efficient markets hypothesis is true, that you cannot make money trading stocks. Why? Because whatever you're basing your trading strategy on, according to the EMH, depending on the version, for example, if I'm doing technical analysis, I'm looking at the price chart, I'm trying to predict trends, well, even under the weak form of the EMH, that already is worthless because all of that information is already priced in. Maybe I'm doing fundamental analysis. I'm looking at, I'm looking at the news, I'm looking at the company's financials, I'm looking at all kinds of data. This going by the semi-strong form, that's worthless too, because all of that public information is already priced in. And if I'm going by the strong form, there is nothing I can do, even using insider tips, because that information is going to be priced in also. So if I truly believe the EMH, what is that saying? That's saying that basically succeeding on the stock market is 100% a function of luck. Skill does not play into it at all, because any basis for a successful trading strategy, whatever information you're basing that trading strategy on, is already incorporated into prices. So whether you're correct or not about where the price of different assets is going to go, it's completely a function of luck, because the future price movements are all based on information that we don't have. Now, I think this is kind of painting with a broad brush, but I think it's fair to say that the pro EMH people tend to more be academics, and the anti EMH camp are usually more financial practitioners. So why is that? Well, that seems pretty obvious, right? For financial practitioners, their livelihood depends on convincing people that they have some type of knowledge, that they have some kind of skill set that allows them to make money on the stock market, and not just as a function of luck, but be able to make money on the stock market consistently, right? So if you came around and started telling all these people that, hey, all the money that you made, that's completely luck. Whatever you were basing your trading strategy on, that's all priced in anyway, right? Any success you've had is just based on luck. Of course, when you tell people that, they don't want to hear it, right? Why do academics tend to be in favor of the efficient markets hypothesis? Well, once again, it comes down to incentives, right? Academics like to present a vision for how systems operate that's more structured and operates by a certain type of logic, right? Because you can model it, you can make predictions, you can say all sorts of things, right? You can write papers based on this sort of structure that you've established. And so academics like the EMH, well, because it's a very nice, clean statement, and it gives us a kind of view of the markets that's more structured, right? So because of the nature of this statement, we aren't going to definitively come down on one side or the other, and this is something that you're going to have to make a decision for yourself about how much you really believe in it. However, we want to think about, according to the efficient markets hypothesis, nobody should be able to consistently make money on the stock market. So the question is, how true is that? So if you look at this table, this compares a number of different stock indices to the performance of actively managed mutual funds. So we can invest in index funds which are passively managed. All they're doing is tracking an index, which means that their returns are not determined by the skill of the fund manager. Whereas with an actively managed fund, where the fund manager is picking which stocks to invest in, there you can think about the performance of that fund is down to the skill of the fund manager. So how do actively managed funds perform relative to passive funds? So these percentages represent the percent of actively managed funds that are outperformed by the passive index, in which you can see that pretty much across the board, passively managed funds, the ones that just track an index, do better than actively managed funds, funds that are run by a manager who presumably is very smart, very knowledgeable about markets, and is paid a pretty substantial fee to manage these funds. Passive funds are popular specifically because they have very low fees, because the belief is that, well, this is not something that requires any human input, so there's no need to pay somebody an exorbitant fee to manage this fund. Well, you can see that passive funds, not only do they have lower fees, but they also perform better overall. Now, that argument is something that, if you're an advocate of efficient markets, you tend to get thrown out a lot. And the counter argument to that is, well, sure, most people can't successfully trade. They can't beat the market. However, there are always going to be a few exceptional individuals that can consistently win. And so we can't rule out the possibility that there is some way to make money trading. We can't rule out that there is some strategy that works. Maybe most strategies, most funds, most traders fail to beat the market. But we do have some examples of people who have consistently been able to outperform the market throughout their career. Well, if you believe in the EMH, this is not going to convince you either, because even if you're talking about someone who can consistently beat the market, we can't rule out luck as the main culprit here either. So let's just think about a very simple example. Let's imagine that for everybody, beating the market is just a coin flip. So every year, you have a 50-50 shot of either outperforming the market or doing worse. And let's imagine, well, okay, if it's a coin flip every year, what are the odds? What's the probability that you can beat the market 10 years in a row? Well, if you imagine each year being an independent event, that's going to be 0.5 to the 10. There's about 0.1%. So pretty low chance, right? Pretty low chance that you'll be able to beat the market 10 years in a row. So if it's that unlikely that you can beat the market 10 years in a row just as a function of dumb luck, does the fact that there exist people who can do this disprove the EMH? Well, not necessarily, right? Because the probability that any one person can accomplish a task is not the same as the probability that if you have a large group of people, that at least one person can do this, right? So let's imagine that I had 10,000 people, okay? And so if this is the probability that you can beat the market 10 years in a row, then the probability that you don't beat the market 10 years in a row is 1 minus that, so about 0.999. So almost guaranteed for each individual person that you're not going to be able to beat the market 10 years in a row. But if I have 10,000 people, then, well, if I think about each of those as being independent, then the probability that each person fails to beat the market 10 years in a row is going to be 0.99 to the 10,000, which is going to be pretty close to 0 actually. And therefore, the probability that of the 10,000 people that at least one person beats the market is near 1. So what is this saying? That means that, yes, most people can't beat the market, but we do have a handful of examples of exceptional individuals who have been consistently successful. While it is unlikely on an individual basis that any one person can do this, given a large enough population of traders, it is possible, and in fact virtually guaranteed, that just as a function of luck, some people will have emerged who appear to have been able to beat the market through skill and knowledge, but are just doing so because they got lucky. Now, once again, we're not saying that people like Warren Buffett necessarily just got to where they were because they were lucky. What we're saying here is just that we can't rule out luck as a reason for that. So what does this all mean for the EMH? Should we use it? Is it something meaningful? Well, when we're doing any type of science, we don't want to get in the habit of making claims that can't be disproven, because really that's as much a weakness as a strength. Because if I'm going around making a claim that can't be disproven, then, well, there's not a conversation you can have about it, right? I can't prove the EMH, nor can I disprove it, so I can always come up with some reason why your supposed counterexample doesn't actually work. But that's not really that compelling of an argument, right? Now, as to how you can apply the efficient markets hypothesis in your own life, now I said from the beginning that we weren't in the habit of giving you guys trading advice in this class. However, when we say that most traders can't beat the market, you should probably put yourself in that category as opposed to the category of exceptional individuals who have some, miraculous strategy or some great knowledge that's going to let you be successful. In terms of the kind of structural disadvantages you face, presumably as a student versus, being part of a large financial institution with a lot of money behind you and, access to information that the average person won't have, you're going to be at a huge disadvantage. So if you take away anything from the EMH, at least for you personally, it's probably not a good idea to try and pick your own stocks. You should probably just stick to index funds. With that being said, however, there is an interesting little paradox that arises from this, right? Because remember we talked about this idea that the EMH functions to the extent that it does because if there is information to be traded on, people will trade on it. That's how prices are kept in line. However, if everybody just decided that, well, I can't make money on the stock market, I don't even want to try, let me just buy and hold an index fund and just set it and forget it. Well, in that case, we don't have enough active traders to actually keep prices in line, right? When there's a new piece of information that emerges, and new information is always emerging, that price can only be incorporated into the price if somebody's actually acting on it. And if everybody decides they just want to be a passive investor, there's not going to be enough people to actively trade, and therefore that is going to cause prices to drift from their true value. So there's an interesting little bit of an inherent paradox too involved with the EMH. And if we're specifically talking about the strong form, well, there's an even stronger argument why the strong form efficiency probably doesn't hold. So the strong form of the EMH says that all information, including private information, is priced in. But whatever the nature of private information, usually this is the kind of stuff that at least has some cost attached to it, right? Getting inside info is always hard. There's always some type of cost you have to pay in order to access it. Otherwise, it wouldn't be private. So, in order to want to pay the cost to access private information, there has to be some benefit to it, right? And what's the benefit of private information? That you can trade on it and make money. Well, if you couldn't make money from inside information, you would never want to pay the cost to access it. So in that case, if private information were not profitable, not only would nobody trade on it, nobody would go through the effort of gathering that information. And therefore, there would be no mechanism to incorporate that into the stock price. And you can apply a version of this argument, which is called the Grossman-Stiglitz paradox, to the weaker forms of the EMH as well, right? Because, so we said private information is costly. If markets are efficient, I don't want to pay the cost because I can't profit from it. Well, some types of public information are also costly. You think about, just because not all public information is something that you can get just from watching the news, right? Sometimes it requires a lot of analysis to get at, right? Maybe you're using a publicly available data set, but the process of going through and doing the analysis to get the information that you want out of it, that can be very time consuming, very costly, right? And if you weren't able to trade profitably on that, you wouldn't want to do that either. So a variation of this paradox can also be applied to any version of the efficient markets hypothesis, right? That even public information can be costly to acquire, and if I can't profit from it, I don't want to gather it. Okay, so let's imagine that we did believe the EMH. Well, what are stock prices going to look like if markets were efficient? Well, we said that if markets were efficient, prices would reflect all information from the past. That means that future prices depend on the current price. I can have a drift term, but all of the random shocks, all of the shocks that are going to move the stock price are going to be based on events that happen in the future. And as far as events that happen in the future, they may as well be random to me, right? So when we talk about stock prices fitting a random walk, it's not necessarily the case that I believe that stock prices just move based on pure randomness, but stock prices move based on information from the future that I don't have access to. And so from my perspective, as far as I know, it's random. I have no ability to predict these future shocks because any information that I have is already priced in. The future shocks are based on future information that I don't have access to. So if I have a stock that has zero drift, that means that PT plus 1 is just PT plus this error term. And this type of random walk is called a martingale. So weak form efficiency says that the future expected value of the future price given the current price and all past prices is equal to the current price. More generally, the semi-strong form says that the price is the expected future price given all information I have today. So for the semi-strong form, this would be all public information. For the strong form, this would be all information. All right. So this is if I have a martingale. There's no kind of predictable drift in the prices. Then the current price is the expected value of the future price given the information I have today. And I can define the information I have today based on the different forms of the EMH. So if I have a random walk, then the return, which is going to be the change in the price, is going to be the drift plus this error term. And we said that these errors were IID, so they were independent, which means if I look at the returns in successive periods, this is going to be the covariance, mu is a constant, so it doesn't enter into here, of these error terms. And because these error terms are IID, this covariance should be 0. Okay, so if stock prices followed a random walk, and the random walk would be an example of something that fit the efficient markets hypothesis, then I would see that stock returns on consecutive periods have no covariance. That just because a stock went up this time doesn't tell me whether it's going to go up next period or not. Now, this gives us some type of empirical test, because if it is the case that successive periods of stock returns are not correlated with each other, then that at least would mean that stock prices would fit the efficient markets hypothesis. It wouldn't prove the hypothesis was correct, but it would say that the data fits that hypothesis. Well, if we look at these pictures, we can see that indeed, for each of these stocks, there's basically 0 correlation between this period's return and next period's return, which means that at least we have some reason to believe that the efficient markets hypothesis works, because stock prices do at least fit a random walk. Once again, it's pretty obvious why this is the case, right? We need to have 0 serial correlation, because if it were not the case, if the correlation were significantly positive or negative, I could use this period's return to predict next period's return. And if I can predict next period's return, then I can make money from that, right? If the correlation is positive, then if I see a high return, I expect the return will be higher next period. If I have a negative correlation, well, I can still use that information, because I know if the stock price went up this time, it's more than likely going to go down next time. So once again, that's a piece of information I can use to make money. So, and if it were possible to do this, right? If it were possible to use this information to make money, well, once again, this information would be incorporated into the prices almost immediately. So if I notice a trend and I'm trying to use the trend to predict what happens in the future, once people start doing that, the trend will be destroyed. Now, this is kind of true, right? But of course, in practice, there are certain trading strategies that are based on trends, that are based on momentum, and we can't say that trends don't matter, right? Because according to the random walk, cut this part. According to the random walk hypothesis, trends don't exist. There's just things that look like trends, right? So the fact that there are still some strategies that do take advantage of trends means that this mechanism, while we can understand it, is not perfect. So another way we can try to test the validity of the EMH is to think about, well, all right, if I have a random walk, then the price is driven by future news. So future events are shocks that are incorporated into prices as they happen. So according to the EMH and the random walk hypothesis, any type of news, any type of announcement, any type of event that happens that matters, that should cause the price to either spike or to drop immediately, right? Because that's a result of that information being incorporated into the price to its full effect immediately. So for example, let's imagine that I had some type of positive news, right? Maybe I had a good earnings announcement, right? I would imagine the price to kind of fluctuate, and then on the date that the news happened, let's say I had a positive earnings announcement, it would just shoot up immediately and then continue to follow a random walk afterwards, okay? I would not expect the price to kind of slowly reach this level, nor would I expect the price to shoot up and then correct down, okay? So, according to the random walk hypothesis, news is incorporated to its full effect on the day of the announcement. There's no underreaction and there's no overreaction. So, how does this hold up in practice? Well, the results here are a little bit mixed. If we look at the reactions to takeover announcements, so a takeover announcement means that somebody else is trying to take over your company, which means that they'll likely pay a significant premium over what the current market price is, and this is good news for the stock. What you can see with a takeover announcement is that for the most part, the information is incorporated on the day of the announcement, though it's kind of curious because you can see that it starts to drift upwards just a little bit a couple of days before the announcement. So you can think about this is the result of a little bit of information leaking before the formal announcement is made. What about reactions to earnings announcements? Now, earnings announcements, right, it could be a positive surprise or it could be a negative surprise depending on whether it met expectations or not. And what you can see is that the reaction to earnings surprise is a lot more muddled, right? And specifically what you can see is that the full effect is often not captured on the day of the earnings announcement. There's sort of a drift afterwards. So this would indicate an underreaction, that the full impact of the news is not being incorporated into the price right away, but rather it's incorporated over time, which is not what the EMH would say would happen. So we have certain phenomena in markets where we might have underreaction, and there's also certain situations where we have overreaction. And this would tend to go against what the EMH would say, right? Now, the reason for this is that, well, the EMH kind of relies on everybody behaving rationally to an extent, right? That everybody is just out, to maximize their own profits. And so they're going to take advantage of information as soon as they can to the maximum extent that they can, but no more, right? I'm not going to overdo it. But, well, especially when we're looking from a behavioral perspective, this is not really how people actually behave, right? Because just because I have some knowledge that I think is relevant doesn't mean I'm going to act on it right away, because I'm not necessarily going to be approaching my investment decisions like a rational investor. So what are some things that I might do that a rational person would not do? Well, one thing is that I might be overconfident, right? I might go in too much on a piece of information that ends up not really mattering, right? This is going to cause overreactions because traders are going to overdo it, right? Another behavioral bias that's really relevant is anchoring. So anchoring basically means that the first piece of information you get about something is going to be overweighted relative to later information. So you can think about anchoring as being sort of like what they always say about, it's important to make a good first impression, because the first impression that you have of something will stick with you, even if stronger information comes along later on that contradicts it. So if you just have a bad impression of a particular stock, then that initial piece of information will outweigh, in your mind at least, later information that comes along that should supersede it. Another behavioral bias is herding. So, of course, people all like to claim that all of their actions are driven by thoughts that they came up with themselves, but this is obviously not true, right? People do like to jump on the bandwagon. So more than that, people want to wait until they get some kind of external validation from their beliefs. So I might think something about a stock, but I want enough other people to also think the same thing before I act on it. So herding is an example of something that will lead to underreaction. I'm going to wait until I get some other people to validate my beliefs before I act on them. And so when I'm talking about behavioral finance, there's all kinds of different biases and psychological effects that I could consider that make my behavior a lot more complex than if I was just trying to maximize profits at all times. Now, what Fama said about this was basically, well, yes, you have some biases that cause overreaction, some biases that cause underreaction. So on balance, everything still more or less gives me the efficient markets on average. There's no indication that there's some kind of fundamental mispricing that can be exploited. Now, one last thing we want to consider, and this is something that always attracts a lot of public attention because it's very curious and very absurd sometimes, is asset bubbles. So when you have an asset bubble, like for example, you think about the dot-com bubble, think about the housing bubble, think about all these different asset bubbles that we've experienced over the years. It's pretty hard to argue that the EMH continues to apply throughout a bubble, right? Because at least in hindsight, when the bubble bursts and people realize what they were really investing in, it always becomes one of those situations where it's like, man, how could I possibly have believed that this was something that was actually worth investing in? How could I possibly have been so foolish to actually buy into this thing when all the information that's revealed to me in hindsight shows that I should never have believed this? Obviously, the key word there is hindsight, right? Bubbles, they don't necessarily disprove the efficient markets hypothesis because, well, at the time, people didn't know any better. Yes, in hindsight, the dot-com bubble was pretty obvious, but of course, a lot of things are obvious in hindsight, right? A lot of mistakes are obvious in hindsight, and the efficient markets hypothesis is specifically focusing on, well, at this point in time, given all of the information that we have now, is the price correct? And at the risk of dating this lecture, we can think about a great example these days of this is crypto, right? So there are some people who really believe that crypto has a future. There's people who believe that this is just a bubble waiting to happen. And depending on what the market looks like at the time that you're watching this lecture, maybe one of those may have been proven right. However, crypto is also one of those things. And just like has happened with all other potential bubbles, it's one of those things where people have called it a bubble multiple times in the past. And if I think about the dot-com bubble, yes, the first dot-com bubble was really bad. Well, people have been calling for a second dot-com bubble pretty much since the first one collapsed, right? So ever since the tech industry resurged in the aftermath of the dot-com bubble, people have been calling it a second dot-com bubble, right? So yes, bubbles are pretty obvious in hindsight, but at the time, there's just as many people who believe in these assets as people who think that they're about to go down at any point. And this is one of those things that can only ever be revealed in hindsight. Now, asset bubbles are kind of difficult to deal with because, well, think about what mechanism we rely on to keep prices in line, which is arbitrage, right? That whenever there's mispricings, I can use arbitrage strategies, which will naturally correct the price. However, there's a saying that goes, well, markets can remain irrational much longer than you can remain solvent. So even if you really believe that an asset is fundamentally mispriced and you act on that strategy, while yes, this should lead to immediate profit for you, also, the price can remain far from what you think it should be for much longer than you can keep that strategy active, right? Yes, there's going to be, if you truly believe that something is fundamentally mispriced, then there will be a correction eventually. But you may run out of money long before that correction happens, which means that the price can continue to drift from its fundamental value without this sort of mechanism to correct it. And so dealing with bubbles from the perspective of efficient markets is difficult because it's not necessarily the fact that the existence of bubbles disproves the EMH, because we can only really identify them in hindsight. But at the same time, it does present a challenge because the mechanism that keeps prices in line, these trading strategies that identify fundamental mispricings, also don't really work during bubbles as well as they should.